Everyone thinks Bitcoin's wild price swings were driven by technology. They weren't. For years, the story went like this: Bitcoin surged because it was revolutionary. A decentralized currency immune to government control, built on cutting-edge blockchain technology. The fundamentals were sound. The future was digital, so the price climbed from under $1 in 2010 to nearly $70,000 by late 2021. Technology explaining price. Clean, logical, wrong. Here's what actually happened. Between 2017 and 2021, Bitcoin wasn't priced by engineers or economists analyzing utility. It was priced by retail investors watching their neighbors get rich. FOMO, fear of missing out, became the engine. Reddit forums exploded, memes proliferated. Every dip felt like a buying opportunity because the last 5 dips had bounced. Price history became prophecy. But here's the crack in that story. If Bitcoin's value was rooted in technology, why did price spike coincide with celebrity endorsements and celebrity meltdowns? Why did a single tweet from a billionaire move the market 20% in hours? Why did institutions enter asterisk after asterisk? The price had already climbed tenfold, not before. That's not technology adoption. That's momentum chasing. The real driver was liquidity and leverage. As Bitcoin grew more accessible, easier to buy on exchanges, offered on trading apps, available in retirement accounts, the barrier to entry collapsed. Simultaneously, derivatives markets exploded. You didn't need to own Bitcoin to bet on it. You could use borrowed money to amplify gains. More participants, more leverage, more volatility. The price wasn't discovering value. It was discovering how much money could flow in. And then there's the psychological layer. Bitcoin offered something traditional assets didn't: the narrative of the underdog, a currency created after the 2008 financial crisis explicitly designed to bypass banks. Buying Bitcoin wasn't just an investment, it was a statement, a bet against the system. That identity premium is real and it's invisible in spreadsheets. It inflates price. So when the price hit $69,000 in November 2021, what was it actually reflecting? Not Bitcoin's utility as a currency. Transaction volumes couldn't justify it. Not scarcity alone. Scarcity exists by design, not accident. It was reflecting collective confidence that the next person would pay more. That's the definition of speculative mania. And manias, by definition, don't last. The implication isn't that Bitcoin has no value. It's that its price from 2017 to 2021 was decoupled from any stable valuation model. It was a bubble, not because the technology was fraudulent, but because price moved faster than any rational assessment of utility could support. And bubbles leave wreckage, fortunes made and lost, retail investors who bought at peaks, lessons forgotten until the next mania. That's why Bitcoin's pre-2022 price history matters. It's not a prediction of where it goes next. It's a case study in how liquidity, leverage, narrative, and human psychology can untether price from fundamentals, and why that gap always eventually closes. Understanding the machinery behind the price tag is how you avoid becoming the next bubble's casualty. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to see how history's biggest manias unfolded and what they reveal about ours. This video is for educational and informational purposes only and is not financial advice. Always do your own research.